We already know that SIP is a great investment concept. People have been doing SIPs for now many years. But is there a foolproof way of getting the SIP right? Can SIPs create enormous wealth for you at the end of the day? How to ensure that your SIP is a huge wealth creator for you? That's the question that we're going to answer today. And to do that, we have a 10-point formula that we want you to keep in mind before you commit to an SIP. And our belief is that this 10-point formula, if you were to adopt into your SIP practice, will make sure that your corpus is really, really large and is tuned to make you wealthy. Now let's dive in and understand what are those 10 things that one needs to remember when one is doing an SIP. First, instead of just doing a number-based SIP, let's say 5,000 rupees, 6,000 rupees, 10,000 rupees, whatever be that number, always makes sense to align your SIP to a goal. I have a goal for a vacation 5 years down. I have a goal for a down payment for an apartment that I'm thinking about. Align your SIP to a goal. Always a great practice to make sure that you stick to that goal. As humans, our minds are oriented to make sure that we stick to our goal post. Doing an SIP just for the sake of SIP is not a great idea. Second, what is the appropriate amount to start with? That's a question that I often get asked. There is no minimum amount. Start with an amount that you're comfortable with. It shouldn't be too small. It shouldn't be too large, too difficult to do. Remember, it's more important to do month on month in a disciplined way than to try and do a large amount for a couple of months and then stop for a couple of months not able to continue. So it's always good to continue a practice. So start with an amount that you're comfortable to do, and then over a period of time, modularly you can keep increasing as you get comfortable and as you're able to add more money to it. So the magic word is discipline, and that's really the key to creating long-term wealth. It's not big amounts, it's doing it consistently over a long period of time. That's really the formula. What kind of funds should I look at is another question that I often come across. My advice, if you're starting SIPs or if you're new to mutual funds, start with hybrid funds. Typically, a combination of equity and debt is the best way to go about an SIP if you're new to mutual funds. Or even a large cap fund is also not a bad idea. But if you have experience, you've been doing mutual funds for many years, then you may even go to mid and small cap in some form or fashion. All depends upon your temperament and how you would like to take it forward. But I always discourage people from looking at sectoral funds or thematic funds as SIP ideas, because these have a very narrow window in which they perform very well, and for most other times they are out of favor. So I generally don't recommend sectoral or thematic kind of funds for SIPs, whereas it's a great idea to look at diversified fund. Even tax saving funds can be brilliant ideas for SIPs. That way you're also investing, you're also saving tax, and you're also averaging your capital. All of it plays well together. Brilliant idea. One more thing which I don't recommend is debt funds. It's not a great idea to put money away into a debt fund, that too on an SIP route. Why? Because over a long-term average, debt is not likely to outperform in a big way inflation, which means that your long-term debt average return is also going to be close to your inflation rate. Doesn't make sense. When you're prepared to be in the game long-term, I think you should look at getting a higher return, and that will only come out of equity returns. So good to stay with either equity funds or hybrid funds as an idea. Bad times are the best times for SIP. Extremely important to follow through your SIP, especially when things are not doing well in the stock market. Typically, when the stock market is on an upward journey, everybody wants to put money into mutual funds or SIPs. But stock market is not a singular linear upward curve. There will be a time when the markets are significantly down. There are global events, there are local events, and so many other things influence the market. In times like these, typically investors tend to have a temptation to stop their SIPs to prevent more losses on their portfolio. Unfortunately, it is totally a wrong move, because when the markets are down is when you buy more units because the NAV is significantly down, and that's the time when you need to at least keep your SIP going, if not increase an SIP. So look at it counterintuitively. So when the market is down, either increase your SIP or keep the SIP going. Eventually, over periods of time, when the market recovers, you will see that you made a ton of return on your investments. When you're devising an SIP plan, count inflation into play. Just as expenses go up year on year, your income also goes year on year. So your SIP must also go up year on year. So have a plan to bump up your SIP. Use the increment in your income every year to increase your SIP book so that the final amount of SIP becomes a more relevant figure. There is a concept called step-up SIP which you can choose, wherein the mutual fund company itself will step up the SIP book at various points in time to make sure that your SIP book grows. As compared to a flat SIP over a 10-year period, a step-up SIP of even a 10% year on year can be a huge alpha to your overall return. Makes sense to look at a periodic increase in SIP. Ideally, at least once a year, you need to look at it. Now, one of the questions I commonly get asked is, how many funds should I invest into? Now, in my mind, the golden rule is anywhere between 2 and 5 or 6 funds will be a good number for somebody. So which means that if you want to do a 10,000 rupee SIP, I'd recommend pick 2 funds. If you are doing a 1 lakh investment in SIP, I'd say pick 5 or 6 funds, max cap. Just because for 10,000 you're looking at 2 funds, for 1 lakh you cannot look at 20 funds, right? The reason being is that every mutual fund of a certain variety invests in the same pool of stocks. Between a 10 fund and a 20 fund, the overlap of companies will hardly be 1 or 2%. And for that, increasing the number of funds will only make it more confusing for the investor. So I would largely say up to 6 is very, very comfortable and you should stay with it. How do I choose a fund? That's again a question that often get asked. What kind of analysis should I do before I pick the right fund? Now I have a 3-point formula that I would recommend all of you to follow. It's called DRT. Now D stands for look at a diversified fund. Don't go for thematic, don't go for any of those funds. Like I mentioned, go for something that's well diversified. That way, your risk also is reasonably diversified, or even a hybrid fund is a great idea to choose. Assess your own risk appetite. Each of us are different and your risk appetite is different from that of your friends. So assess your risk appetite and align the SIP investment or the mutual fund to what you are comfortable with as per your risk appetite. Extremely important. Third, look at the track record of the fund. Now, when I mean track record, I'm just not looking at a number. A 10-year track record of 2 different funds on a SIP basis could really be the same amount. But if you did a more detailed analysis and find out that in those 10 years, the first 3 years, one fund has done superlatively well, the next 3 years it has done superlatively poorly, and the last 4 years it's kind of averaged out, so that the weighted average of all this comes a certain number. As compared to this, if you had a choice in another fund which has been on an average performing at a certain steady pace, Never too high, never too low. That's the fund I would go with, because that fund manager is taking lesser risk to generate returns for you and is more consistent in his journey. So that's the fund you need to look at. So choose the vehicle that fulfills the DRT criteria, diversified fund which is aligned to your risk appetite and which has a very good consistent track record. That will be the best formula for you to get it right on your SIP. Next up, what's a good age to start SIP? Should I start at 20 or should I do it at 75? There is no right age, wrong age. As long as you have a goalpost, you have a surplus, I'd say go for it. The first salary check is a great time to start SIP because your runway is reasonably long. As you get older, when you're in your 70s, it becomes a lot more challenging, but it's not an impossible. 70-year-old people who have a certain income and much less expenses than the income, the surplus can still be deployed in SIP. Only thing is, if you're choosing an equity-oriented product or an equity-oriented hybrid product, you will need to keep a 5-year window for those to perform. So typically for senior citizens and people above that age, if you're pursuing an SIP, remember that money, you need to give it a 5-year to perform. For younger guys, no questions asked, go for it. Since mutual funds are extremely flexible products, you can start an SIP 3 months down, you can stop an SIP as well. Now many people get attracted to the idea that they will start a large SIP and then if they are in a crunch, they would like to stop it as well. Our advice to you would be SIP should be looked at as a retirement EMI. Just as we have a home EMI, which we don't stop ever. You know, we even borrow money to pay your EMIs because that's as important as that. Your SIP also needs to have the same discipline if you want to get it right. And typically, if you did that over long periods of time and continued your journey, that's when you create stupendous wealth. The SIP journey really comes to play between the 10th and the 20th year. That's when wealth creates massively once because of the power of compounding playing together. So make sure that you're patient and you have that. Last but not the least is patience is a big game in SIP. Many a times people look at their portfolio after a year and look at that it's not done great, it's not changed much, and would like to change from fund A to fund B. No way. SIPs, you need to give it a 3 to 5 year period for you to see substantial results coming your way. And after 10 years is really when the results show stupendously well on your portfolio. Given that the equity markets, Indian economy is doing really well, we believe a 10-year to 20-year SIP will help you create great wealth, for which you need to develop a habit of patience. If you followed these 10 practices, I am sure you will have a stellar SIP experience and you will also end up creating a great corpus for yourself. All the very best. I hope you loved the episode. I have a quick quiz question. Now, just as inflation impacts our expenses, there is a way in which one can protect your SIP corpus as well. What is the one way in which one can protect the SIP corpus? Answer in the chat box below, and we'd be very interested in knowing about the answers.